Hey everyone, this is Joshua Martinez with Market Traders Institute. Earlier today, about 6 hours ago, I made a post and I kind of just asked everybody on Facebook and social media and said, hey, do you know what a Gartley is? And would you like for me to make a video on it? And many investors said, yeah, I want to know what it is. There's a lot of different definitions out there. How does Market Traders Institute use it? And so what I want to do is I want to show you how we utilize it, how we identify it, market conditions, and when it usually appears, and how it can assist you in identifying U-turns. Because if you can identify U-turns, you can really maximize profits and begin to minimize risk. And so a Gartley, G-A-R-T-L-E-Y, is the movement from the B to the C. And if you don't know your ABCD swings or Fibonacci's, this is going to be a little confusing for you. And so we do suggest that you educate yourself on that aspect. For those of you who do know what it is, it's going to be very simple. This is going to be very easy to understand. And when the market moves, the market typically will move in a trend fashion to where we have higher highs and higher lows, higher highs and higher lows on the way up. And our job is to buy low and sell high to make a profit, right? Just like if you're selling ice cream, you buy your ice cream for 10 cents and sell it for $1. Same thing in the market. But we don't just label it, higher highs, higher lows. We label it like this. We have your A, then your B to your C, and then your C to the D. And what we begin to do is when your D extension is fulfilled and the market resets, your C becomes the new A and your D becomes the new B, and then the process repeats itself. So you have A to B, C to D. And when the D is finished, A, B, C, D, A, B, C, D, C becomes A and D becomes B, and then here's your new C and there's your new D. So you have A, B, C, D, A, B, C, D, A, B, C, D, and the process continues to repeat itself until the A is taken out. So this is a very clean chart or example, but let's look at realistic examples, okay? When the market is moving fast, you have very clean lines. Extension up and then a retracement, right? Extension up and then a retracement. But when it begins and when the market slows down and has a larger distance to travel, it begins to form multiple higher highs and higher lows on the way up, and then forms multiple lower lows and lower highs on the way down, and continues this process. And the big picture is still A, B, C, D, etc. A, B, C, D, A, B, C, D. And so you see how this right here, the movement from the B to the C, is just a short-term retracement because the longer-term move is still pushing up. You see, if we even drew your hand-drawn trend lines, you'll begin to see that you had an uptrend and then a short-term retracement, downtrend, and an uptrend and a short-term retracement, downtrend, an uptrend. A Gartley is going to help you identify when this short trend is down, when it's over with, when the short-term pullback is over. Because if you've ever seen a market trend, and if you've ever seen the market begin making lower lows, lower highs, and you say, wow, this is fantastic. I can't wait to sell it. It's a perfect setup. You enter in, and it goes against you. It's because you traded in the short-term position. And what we want to do is you want to use a Gartley to assist you to identify when that happens. Now, usually it's your third, fourth, or fifth A, B, C, D swing to where you have multiple swings between your A and your B boundary. So this is your A. Once again, here's your capital A. This is your capital B. And the C is going to be somewhere down here because it needs a nice buy, it needs a nice drop for a buy low price. And so that movement's going to look just like this. It's going to come down, it's going to come up, and then it's going to fall down once again. And this is what's known as a sub A, B, C, D. And if you use Fibonacci's, this will be in the Fibonacci extension. And when that Fibonacci D extension is fulfilled, that is usually your capital C. And it is a scream to buy. It's like yelling at you, buy, 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 buy. And then you look to buy it. And then this happens. The market begins to make higher highs and higher lows, higher highs and higher lows. So A, B, C to D. Okay, capital A, capital B, capital C, capital D. The goal is to use your sub Fibonacci's and your sub A, B, C, D swing and the distance from the B to the C, B to the C to help you find the capital C. So the Gartley is going to help you understand your short-term trends versus your long-term trend. So what we want to do is we want to buy the movement from the A to the B. We want to stay out from B to C, but then we want to use the Gartley to help us find out when the short-term retracement's over, and then we want to start buying again from the C to the D. Many investors say, well, why don't we trade this? Because it's hard, right? Why would we want to trade in a hard market? So if you have questions, let me know. Post wherever this video is going, post on it, and let me know. For those of you that do not know about Fibonacci's, if you would like for me to do another video or quick explanation on how a Fibonacci works, let me know. Comments in the post below or to the side or wherever it is. And this is Joshua Martinez from the Marketers Institute.